Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we are going to learn a tutorial on current liabilities and which are the list of the current liabilities on the balance sheet. At the very inception end, let's look at the end of how does it really looks like. When we see the current liabilities, we see a couple of things like notes and loans payable, current portion of the long-term debt, accounts payable, accrued income taxes, other accruals, which gives us the total current liabilities. So let's get into the nitty-gritty of the same. At the very first thing, what exactly? First, what is current liability on the balance sheet? Current liability on the balance sheet refers to the debt or the obligation that a company basically owes. This is a very important word, owes, and is required to settle within one fiscal year or its normal operating cycle, whichever is longer. Such obligation will require the use of the current assets like the cash, the creation of the non-current liability, or providing service for settlement. So these liabilities are recorded on the balance sheet in order of shortest term to longest term. The definition does not include the amount that are yet to be incurred as per the accrual basis of the accounting. Like for example, salary is to be paid to employees for services in the next fiscal year and is not yet due since the service has not yet been incurred. So let's understand now the list of the current liabilities. The first and the foremost thing that we are going to study is the current or the accounts payable, which is also known as your creditors. Accounts payable is usually major component of the current liability, which is representing the payments due to the suppliers within 1 year for raw materials bought as evidenced by the supply invoices. So here is current liabilities example that I'm going to show you. What we note over here in this particular case, this is Colgate's extract of current liabilities. We note over here something that the accounts payable is 1124 and in the previous year it was 1110. So the accounts payable has significantly increased as compared to 2015. The next thing that we are going to go about in case of the list is the notes payable. Notes payable are basically a short-term financial obligation evidenced by negotiable instrument like bank borrowings or obligation for equipment purchases, may be interest bearing or non-interest bearing. Third thing that we are going to learn is the bank overdraft or bank account overdraft. Short-term advances over here made by the banks to offset accounts overdraft due to excess funding above the available limit. And you can also learn based on this concept that is called revolving credit facility. The next is current portion of long-term debt. Now, the current portion of long-term debt is a part of basically the long-term debt due within the 1 year of time span. Fifth, the current lease that is payable. Now this is the extract again of the current liabilities, which includes the current portion of the capital lease obligation which we have in our case, right? So as you can see, this is basically the Facebook's extract from the SEC filings. The Facebook's current portion of the capital lease was 312 million and that was 279 million in 2011. The next thing that we have in our list is the accrued income taxes, or the current tax that is payable. When we talk about this thing, income tax, this is basically the income tax that is owed to the government, but it is not yet paid. The next thing that we have is seventh, accrued expenses, or it's a liabilities. Expenses that are not yet payable to the third party, but it has already been incurred like interest and salary payable. So this are basically accumulated with the passage of time. However, they will get paid when they become due. Like for example, salaries that employees have earned but not yet been paid is reported as what? Accrued salaries. The next in our list is the dividend that is payable. Now we all know this term. Dividend payables are basically the dividend that has been declared but not yet, or you can say but yet to be paid to the shareholders. Therefore, they are recorded as the current liabilities in the balance sheet. Ninth, the unearned income or the unearned revenue. Now, unearned revenue are advanced payments made by the customer for the future work to be completed in a short term like advance magazine subscription. Now, the next thing that we are going to learn is how to analyze this current liabilities on the balance sheet. Current liabilities on the balance sheet impose restrictions on the cash flow of the company and have to manage very prudently to ensure that the company has enough current assets to maintain the short-term liquidity. So in most cases, the companies are required to maintain the liabilities for recording payments which are not yet due again. Again, the companies may not want to have liabilities because it lowers the long-term interest obligations. Some of the very important ways by which you can analyze the current liabilities on the balance sheet is as follows. Like the first one, the working capital. Now, what do you mean by working capital? Working capital is basically the capital which means fixed assets work in organization. So working capital can be calculated as is equal to current assets less the current liabilities. That's your working capital. Working capital, a company's liquidity position can be gauged by analyzing its working capital. Excessive working capital means that the level of the current assets is much more higher as compared to the current liabilities on the balance sheet. The excess capital that is blocked up in the asset has an opportunity cost for the firms since it can be invested in the other working capital, which are idle. On the other extreme, you can say that, inadequate or less working capital may pose a short-term liquidity issues, and if the company maintains current assets which are not yet sufficient enough to meet the liability. So consistent liquidity issues may pose problems in the smooth functioning of the firm and affects the creditability of the company in the market. The next way that you can do is by current ratio, or you can do by quick ratio. Let's quickly discuss this. Current liabilities on the balance sheets are also used to calculate the liquidity ratios like current ratio and quick ratio. These ratios are basically calculated something like this. Current ratio is what? Your current assets divided by, you can say, the current liabilities. And your quick ratio, that is QR, is basically the current assets, and you have to decrease something that is inventories in that, and the current liabilities divided by current liabilities will remain the same. So there will be no change in that. While the working capital is basically an absolute measure, current ratio or the working capital ratio can be used to compare the companies against peers. So this ratio basically, you can say, varies according to industry. A ratio of 1.5 is usually an acceptable standard. A ratio above 2, you can say, or above 1 gives an indication that there is inadequate working capital management. Current ratio is used in the financial analysis along with the quick ratio, which is the measure of the company's ability to meet its liability using its more liquid asset. And a company may boast of high current ratio. However, it may so happen that most of its current assets are in the form of inventories, which are difficult to convert into cash and hence are less liquid. So in case of immediate requirement of funds for meeting liabilities, this less liquid assets would be of no help. And a quick ratio of less than 1 would signify that the company would be unable to pay back its current liabilities on the balance sheet. Thus, a quick ratio is also referred to as the asset test ratio, which speaks of a company's financial strength. So, based on this, we can make final conclusion. The conclusion is something: most of the balance sheet separate current liabilities and long-term liabilities. This gives an idea of the short-term dues and is important information for the lenders, financial analysts, owners, executives of the firm to analyze the liquidity working capital management and compare across the firm in the industry. So being a part of the working capital, this is also significant for the for computing free cash flow to the firm. Although it is important prudent to maintain the current ratio and the quick ratio of the at least one should be the case. The current ratio greater than 1 provides additional cushion to deal with the unforeseen contingencies. Traditionally, manufacturing facilities like maintain current assets at a level double of the current liabilities on the balance sheet. However, the increased usage of just-in-time manufacturing technique in modern manufacturing companies like automobile sector has reduced the current ratio requirement.
If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.